Hello, hello. Let's get down to it. The money. Okay? This is on 13 Things They Won't Tell You, page 276. And, well, it's long. So I may not be able to do it just in one time. It may take twice. So you will see. It's in part six of the book. Big advice, smart, simple ways. Oh, smart, simple ways to save money. Okay, let's do it. No matter what the market does, you should know how to shore up your resources so you won't have to worry about every little hiccup. Okay? There we go. Okay. Here are time tested strategies you can master: how to spend less, reduce your debt, make the most of your tax breaks, invest wisely, and finance your retirement. The idea, says William Speciale, a Boston based advisor with the financial planning firm Calibre, is to focus on what you can control. Little steps can really make a huge difference. Okay, taxes. Forget the short form. Okay, most taxpayers, 65% of us to be specific, just take the standard deduction. But you may save money by itemizing your deductible expenses. It doesn't matter if you use an online program, a current tax guide, or a storefront preparer. Out of pocket health care charges, business expenses, including some for job searches, and charitable donations are just a few of the items you may be able to deduct. Fill out the long form, known as the 1040, and compare numbers. If your total deductions are greater than the standard deduction, you'll save money by itemizing when you file. Your kids should file a tax return. I did not know this, you guys. The IRS doesn't care how old they are. If they earn more than $5,450 in a given year in wages or interest income, they have to file, even if you claim them as dependents. And if they have less than that, they should still file because they'll get back all the money their employer withheld. Help them fill out the paperwork. It's a great learning experience that may earn them some extra cash. Avoid a tax refund. You may feel giddy knowing you'll get a check from the IRS this spring, but you shouldn't. Getting money back means you're essentially lending money interest-free to the government for the year. Better to have that cash in your account than lend it to Uncle Sam. So if you've been getting big refunds or have had a big life change, a marriage, a baby, a divorce, a radical increase or decrease in income, adjust the withholding allowances on your W-4 form. You can do that at irs.gov. Use the withholding calculator to determine the correct figure for you. Then print a new W-4, fill it out, and give it to your payroll department. Avoid rapid refund programs. Sure, they sound great. After all, what can be better than getting your money fast? A lot of automobile dealerships do this too. A tax prep chain might try to get you to agree to one of these instant or anticipation options. Don't take the bait. This is not your refund. It's a loan, and a very high interest loan at that. Some have been higher than 120%. If you file electronically, even if it's through a tax chain, the IRS will deposit your refund directly into your bank account within a week or two. Checking and savings. This is a big one. Make sure your free checking is really free. A lot of banks advertise it, but read the fine print. If the minimum balance is steep, thousands of dollars in some cases, look for a bank with no minimum requirement. This is actually on my to-do list. This could save $100 a year or more. Bankrate.com is a good site for comparing accounts. And don't waste $2 on ATM withdrawals at another bank's machines. Bank online. You'll be surprised how easy it is to pay bills, transfer funds, save automatically, and keep track of it all. In fact, gathering records at tax time will be a cinch. And by setting up the automatic bill payment option, you'll help protect your credit score. Banking online is actually safer than banking at a brick-and-mortar institution. Banks have spent a fortune to make sure their sites are among the most secure on the internet. Keep your money in super safe places. Aim to amass at least 6 months' emergency expenses in case you lose your job or become disabled. Where's the best place to keep it? FDIC insured bank savings, CD, and money market accounts are still 3 of the most secure places. Money market funds that invest in treasury bills are super safe too, but low yielding. Internet banks and credit unions tend to pay higher interest rates, but go to FDIC.gov and check to make sure they offer the same government insured guarantee. Look into Series 1. So like if you're getting your payroll via Wisely, and let me see what bank is Wisely. Hold on. It's a bank that I had never heard of before, but a lot of companies are using Wisely through through ADP right now. Let me see. Oh Lord, I wrote it down. Hold on. I wrote it down because I hadn't heard of this bank before, but I kind of want to check them out. Let me see. Of course, I can't find it now, you guys. I'm sorry. I am super duper sorry. I didn't mean to make a reference to it, but it did pop into my head as I was going through this. You want to be able to check. Oh, there it is. Fifth Third Bank. Fifth Third Bank. I just thought that's a weird name. Fifth Third Bank National Association. So you want to check them out at to find out if they should be a reputable bank, but just double check everything, okay? FDIC.gov, IRS.gov, and bankrate.com, okay? So make sure that they offer the same government insured guarantee, okay? Look into Series 1 bonds and Series I bonds and I bonds, which are just as safe and are guaranteed to keep up with inflation. They're also free from state and local taxes and possibly federal taxes if you use them for college costs. The downside, you can't redeem them for at least a year, and if you cash them in before 5 years, there's a small penalty. Other savings options, including corporate and tax-exempt money market funds, are a bit riskier. Compare yields at cranedata.us. So that's cranedata.us. Okay, so here's what is really good. Debt. Cut up your extra credit cards, but don't close the accounts. Yes, it's smart to reduce your temptation to splurge by destroying your cards, but if you actually cancel them, it could hurt your credit rating. Here's why. Lenders worry about how close you are to using all the credit cards available to you. If you close an account, you lose its credit line. As a result, you are using a greater portion of the reduced amount you can now borrow. How many cards do you need? While the average American household has 9, 2 or 3 active cards should be plenty. For me, I got rid of all of them. Close the accounts, cut them up. I don't care what they say. I just think credit cards are, it's a quick way to get yourself into a lot of trouble, okay, financially. Okay, pay your bills on time. A single late payment means that you could pay a much higher interest rate on any future loans and on your existing credit card accounts. That's because even one missed payment can lower your credit score by as much as 100 points. You see what I'm saying? Don't do it. Don't do it. That plunge means that lenders view you as a risky customer. If you're shopping around for a mortgage, you could end up paying as much as a full percentage point more. That's an increase that could ultimately cost you tens of thousands of dollars in interest. Set up automatic payments to make sure you're never late on your major bills. The sooner you can show lenders you're back on track, the better. My grandmother always said, don't use credit. If you can afford to buy it cash, by saving and buying it cash, don't get it. Okay? You don't want to pay the price that they are asking you to pay because normally it's marked up 300%. Whereas if you have cash, you can get a far better price. You're going to pay way less money than the person who whips out the credit card. Okay? No credit. I'm going to put that in my... Don't lend money. Don't borrow. Okay? Put your savings to work. Pay more on your mortgage. Here we go again. Reduce your credit card interest rate. Here we go again. Get your credit report for free. That's something that you can do every year. You can get a free copy of your credit report every year. However, that credit report will not give you your rate. That's the thing. Okay, shop around for car insurance. I like PIMCO. Geico is expensive. The General is expensive. Okay, sign up for an FSA. Many employers offer flexible spending accounts as a way to set aside part of your salary for health care and child care costs. You can pay for everything from Band-Aids to orthodontic work with pre-tax money, which translates into a discount of about 30% or more depending on your tax bracket. But plan carefully. If you don't use all the money in your account within the year, at many companies, you have until March 15th of the following year to submit receipts. You lose whatever's left. And that's why I don't like the flexible spending account. Don't use it. It's not worth it because if you don't use all that money, you lose it. So what's the point of that? It's ridiculous. It's a dumb thing. Okay, keep grown kids on your health insurance policy. If you're going to end up lending or giving your children money for coverage, it's much cheaper to keep them on your policy as long as possible. Hold off on that long-term care insurance. The soaring cost of extended nursing care has prompted many people in their 40s and 50s to sign up for long-term care insurance in order to lock in a rate. It's true that the premiums go up as you get older, but not by the huge amount you might expect. They're really planning on folks to croak before they use it. According to data collected by America's health insurance plans, so beware the source. A 65-year-old may end up paying just $126 more a year. They don't want you to get that long-term care insurance now because they want to make more money off of you. Get it now. Get it now. Okay? Sign up for disability insurance. It helps protect your income in the event you become unable to work for a long period. Ideally, you should have enough to replace 60 to 70% of your salary. If your company plan doesn't provide this much coverage, consider buying more on your own. It can be costly, but it's worth it. Visit affordableinsuranceprotection.com. That's a good website. Affordable insurance protection.com. Okay. Or unum.com for quotes. unum.com. Okay. Think twice about life insurance. If you don't have dependents, you may not need it. If you do have kids or other dependents, you're probably better off with term life insurance until, say, your children are grown and can take care of themselves. It's generally less expensive than whole life or other types of policies that build a value until you die or cash them in. Okay, I think that this is bad advice. I think that if you take out a whole life policy on your newborn, when that child turns 25, then you take down the cash value for them, which will help them with that first job until they're vested. Or if they want to start a business, they can use that money for business. I don't like term life policies, which has happened to even my mother. She outlived that term life policy, so that money is just gone. There's no cash value into it or anything. It's just thrown away. Term life policies I don't like. With my life insurance license that I had, term life, unless a person just says that's the product that they want, I'm not selling no term life policy. It's just a ripoff. Okay? It's just a ripoff. Don't do term life policies. Do whole life policies. Okay? Long or short, it's the better deal. Okay? And that's what you want, the best policy, the best value for your money. Okay. Yeah. I think his advice is suspect. Write your will. Okay. Although no one likes to think about dying, you need to. A will doesn't have to be. Or another thing that you can do is you can buy a pre-burial thing, prepaid plan for your death through like Dignity Memorial. That's something else that you can do. I think that is a good thing because you go the extra. So you can choose your casket. You can choose what you want to have. If you want a cremation, if you want a funeral, if you want it at a church, if you want it at the funeral home, where you want to be buried. All of those things can be taken care of. And even you can pick out your tombstone and everything what you want said on it. So all of that is taken care of and paid for in advance, which I think is very good. So that's DignityMemorial.com. They're very good. Okay. Always have a will. That is very good. Okay. Investments. Stay away from individual stocks. Stick with index funds. Don't buy investment products from your bank. Hello. Don't do it. Don't do it. And I'm going to tell you something else too. Your bank is not there to help you with your financial goals. Okay? They are there to make money off of you. It's very hideous. I can't stand it actually. It says banks sell a wide range of mutual funds, annuities, and individual stocks and bonds. These aren't FDIC insured, and they tend to be more expensive than what you could get elsewhere because banks usually charge high sales commissions. Buy directly from mutual fund companies instead. Go with companies like Vanguard or Fidelity, which charge low fees and no commissions. Okay? Build a portfolio. The rule of thumb is to put 50% of your long-term savings in stocks and 30% in bonds and keep 20% available in cash. That means in a savings or money market account where you can withdraw it at a moment's notice. In tough times, especially, getting the right mix will depend on the risk you're willing to take and how soon you'll need your money. Stocks are generally more risky than bonds, but there are exceptions. For example, bonds issued by companies that are in questionable financial health, called junk bonds, are more euphemistically high-yield bonds, are a lot riskier than, say, stock in utility companies. Okay, retirement. Contribute to your company's 401k. I don't like this. I don't like this either because depending on the company, they can change who has their 401k accounts and not even tell you, oh man, it's a mess. Just don't do it. Just don't do it. You will lose that money. I don't care if you put $100 into that 401k. If they change companies or whatever, that company can charge you a fee that will wipe out all the money that you put in there. Don't do it. This is another scam. Put retirement savings ahead of college savings. Say no to company stock. This is bad. I started my portfolio with company stock in Walmart in the 80s. So, yeah, this is not good. It says say no to company stock. Think of Lehman Brothers, Bear Stearns, and Enron. That's true, but again, those are different stocks than, say, a person that's working for Walmart. That stock is good as gold, baby. That stock is good as gold. So it depends on the stock. It depends on the company. Don't worry about Social Security. You probably heard the dire predictions that anyone younger than 35 can't expect to collect Social Security. Even in bleak economic scenarios, though, Social Security will probably pay you 65 to 80% of your currently promised benefits. And with some fairly modest changes like raising the retirement age or increasing payroll taxes, blah, 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 make sure you're saving enough so you don't have to count on the program for your entire retirement income. And that's it. Bada boom, bada bing, bada boom. Check out those websites. I'm going to check out Unum myself right now and affordableinsuranceprotection.com. Talk to y'all later.